Hi everyone, welcome to G2 Finance Tech's weekly market update. This week we'll start with the US market. It was a holiday shortened but eventful week for US markets. Stocks ended mixed as investors weighed downbeat data and geopolitical risks against possible signs of easing monetary policy. The Dow and S&P 500 ended slightly lower while the Nasdaq managed modest gains helped by tech. Small cap indexes outperformed. One major catalyst was President Trump's comment on Thursday indicating a substantial chance of negotiations with Iran. This hint of diplomatic thaw supported markets on Friday. Still, the broader mood remained cautious as markets continue to monitor Middle East developments closely. The Fed held interest rates steady at 4.25% to 4.5% for the fourth consecutive time, as expected. Chair Powell emphasized that while economic uncertainty has diminished, it remains elevated. The Fed's updated projections still expect two rate cuts this year, though inflation and unemployment forecasts were revised upward. GDP growth projections were trimmed. Interestingly, Fed Governor Waller hinted at a possible rate cut as soon as July, which added a dose of optimism to markets. However, weak retail sales and housing starts tempered that enthusiasm. Retail sales declined for a second straight month, falling 0.9% in May. Meanwhile, new housing starts dropped 9.8%, hitting a 5-year low. Treasury yields fell for most of the week amid soft data and geopolitical tensions lifting bond prices. Investment grade corporates performed well, while the high yield market was a bit more volatile ahead of the Juneteenth holiday. Europe. European equities followed global sentiment lower, with the stocks Europe 600 down 1.54%. Major indexes in Germany, France, and Italy were also in the red. UK equities dipped modestly. The Bank of England kept rates at 4.25%, maintaining a cautious stance amid lingering inflation concerns. UK inflation eased slightly to 3.4% in May, with services inflation falling to 4.7%, matching Bank of England forecast. In a notable shift, both Swiss National Bank and Norway's Norges Bank cut rates, the latter marking its first cut in 5 years. Meanwhile, Germany's investor morale rose sharply thanks to a recent tax relief package, while France's manufacturing sentiment continued to weaken. The Eurozone's current account surplus narrowed significantly in April, reflecting earlier front loading of trade ahead of US tariffs. Japan. Japan's equity markets advanced, with the Nikkei gaining 1.5%. The Bank of Japan left interest rates unchanged at 0.5% and signaled it would slow the pace of JGB tapering starting 2026, easing concerns of aggressive policy tightening. The yen weakened slightly, while bond yields edged up to 1.42%. On the economic front, Japan's core inflation surprised on the upside, coming in at 3.7% year over year in May, mainly due to rising food costs, particularly rice. The G7 summit failed to deliver a tariff agreement between the US and Japan. Tariffs are set to rise in July, though negotiations remain open to dialogue. China. Chinese equity markets drifted lower as mixed economic data dimmed investor sentiment. The CSI 300 and Shanghai Composite fell slightly, while the Hang Seng dropped over 1.5%. Retail sales posted a strong 6.4% gain in May, but industrial output and fixed asset investment lagged expectations. New home prices also fell for the second month, underlining the lingering property sector drag. Despite a trade in subsidy boosting retail figures, the broader narrative remains that stimulus measures are proving insufficient to lift overall demand. The deflationary environment and a weak property market continue to be key challenges for policymakers. So, what is the takeaway? The Fed is staying patient, Europe is watching inflation trends closely, Japan is cautious on bond tapering, and China needs stronger stimulus to tackle deflation and property woes. Geopolitical risks are still a major variable, especially out of the Middle East. That's it for this week's market update. Stay informed and stay ahead. Thank you.